Why the stock market is set up to rally into Fed rate cuts for 2023. Only then it will crash big. They planned all this. What? From last week's S&P 500 price actions, you will think investors must feel bullish. However, there are only 24% of investors are bullish. According to AAII Investor Sentiment Survey, 39% of investors are bearish, 37% are confused. If you are confused, don't worry. Even Drunken Miller is confused right about now. The stock market has been stuck in 4,000 to 4,200 range for 3 Aprils now. Over 700 days ever since April of 2021. 2022, we were right back there. Right now, at the end of April 2023, we are still in that range. The market still can't make up its mind where to go, just like a couple that has just come home from work. They're trying to decide what movie to watch on Netflix, and they keep browsing and browsing and browsing. From comedies to thrillers, browsing for over 70 minutes. Still they can't decide, then they give up, and they fall asleep, and the night is over. Why the stock market is set up to rally into Fed rate cuts in 2023. I will explain it all right after this.
How you like that? How you like that? Nah, look at you, now look at me. Look at you.
Welcome back, everyone, to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my new website. If you're a good boy, go to audaciousmoneywitch.square.site to add more meaning into your life. If you play your cards right and completely submit, like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to be my client, don't you? And here is my collaboration book. It's already yours, Adversity Equals Success. Such an amazing book with such incredible authors. Order your copy today. And here's my client Teddy Eazzy's book, Wicked Pussy Perfume. It is a femdom novel, and it's about money, the stock market, and stalking. Such an amazing author with such incredible content. A shout out for my client Teddy Eazzy and his book, Wicked Pussy Perfume. It's such an amazing book, so order your copy today. Yellen is yellen. The bank system is stable. Nothing to worry about here. Everybody go home. The banking system is like Silicon Valley Bank failed, Silvergate Bank failed, Signature Bank failed, Credit Suisse Bank failed, First Republic Bank failed. They all failed in the last 60 days. Yes, I am still bearish. You know who else is bearish? Hedge funds. They are not only shorting TLT, but also big techs. Hedge funds lose $18 billion betting against tech stock rally. The big techs did way better than expected, and they took the short sellers by surprise. Here is why I believe this is a setup from Wall Street. Last year, when the market went down, all the big tech stocks were affected by Snapchat stocks. It happens like this. They put Snap earnings ahead of the FANG. Meta, Apple, Amazon, Netflix, and Google. Snap is a very long duration stock because it doesn't have positive earnings yet. It used to be a growth stock. It can grow faster than Meta and Twitter when the interest rate is low, but not when the interest rate is high. So Snap can't perform. report misses on earnings or revenue. It actually pulled down Meta, Google, Amazon, and Netflix stock prices and put fear into the market because Snap CEO Evan forecast advertising doom and gloom that affects the rest of the big techs. Plus, in 2022, most of the big techs are all overstaffed. Their earnings are totally affected by that, creating a domino falling earnings market meltdown. However, not this time though. Meta has laid off 3 times since last year. And by that I mean Meta has been laying off workers. Even Google and Amazon did the same thing. This time, notice last week, they deliberately put the biggest big tech stock in front. In other words, the most stable big tech, Microsoft and Google in front. Meta in the middle, and they put Snapchat last. If they would put Snapchat in front this time, the market would probably be lower this week because Snapchat missed on revenue again. It has declined year over year. The stock crashed 18% after reported earnings. It will ruin the vibe of Goldilocks. And Meta most definitely can't rally that 14%. So Microsoft can't jump that 7%. Remember last earnings season, Q4 of 2022. It seems everything is going up. Big tech, small tech, it doesn't matter if you miss on your earnings. This time is different. Wall Street is going back to the benchmark. The truth is, Wall Street algorithm is finding any reason, selling most of the small to mid cap to fund the buying of mega cap stocks. If either stock miss on revenue or earnings, they get dumped 15 to 20% immediately. If you're a big tech with double beats and you repeat AI over 40 times in your earnings call, the stock will fly the next day. It's a true story. Let's take Amazon for example. Amazon with double beats this time. Just because the CEO didn't say AI enough times, the stock got dumped by AI algorithm afterwards. Valuation don't matter when the stock is going down. It doesn't matter when the stocks go to the moon. The AI doesn't care. Another reason why this market is so confusing is because we are stuck between inflation and deflation forces. Inflation fire, demographics, the replacement of retirees and full-timers with part-timers that are less skilled in the workforce. This is inflationary. Expect huge increases for the need of Medicare services and commodities. When the Fed cuts rates to 0, most homeowners refinance their mortgage at 3% or below 3%. This continually puts money in their pocket every month, and this is inflationary. Wage pressures due to minimum wage hikes are making people want more wage growth. And workers can get what they seek due to the demographics. President's energy plan is hugely inflationary. President's push for more union jobs is inflationary. Deglobalization, barely started, is inflationary. Deflation, ICE. Money supply is very deflationary. Rising interest rates are deflationary. Debt is very deflationary when you struggle to pay it back when asset prices fall. Unrealized bank losses curtail lending, and that is deflationary. Bank failing is very deflationary. If the Fed has overshot already, we are headed for a round of severe deflation. Given another hike is nearly 83% certain. If the Fed undershoots or reverses prematurely, inflation can easily come roaring back. We have high inflation coupled with GDP slowdown. This is called stagflation. Will you sell in May? This May is going to be insane. I'm going to give you the 3 reasons why. Number 1, Wednesday, May 3rd. Fed rate hike, Powell's speech. It is my belief that the Fed will continue to raise interest rates in response to recent data that inflation remains persistent. At the same time, the broader economy seems poised to growing slowly. Number 2, Friday, May 5th, U.S. jobs report. I believe the April jobs report won't be as bad as what people are expecting or what people think. There could be more rate hikes, and this might be needed to cool the economy. Number 3, Wednesday, May 10th, U.S. CPI data. My prediction is the CPI is not going to go below 4, and the Fed will have to continue fighting inflation. A bonus reason because you made it all the way here. Apple will be reporting on May 4th. After most of the big tech's successes last week, investors might expect more from Apple. Remember that the Fed said that they want to go higher for longer. Right now, they are still at moving higher stage. They haven't even got to pause stage. Stocks may even go up at rate pause stage. So I expect the stock market to go higher but remain bearish on the economy. You are such a good boy for watching my video right till the end. Bye.